All right, everyone, we are back. Make sure you check in, please. All right, a few more people. And make sure your cameras are on, please. All right, so if you haven't yet, make sure make sure you guys are take advantage of the student portal. Okay, this was created for you. I don't know if you have used it or not just for the Zoom, but you have right here resources, so accessing a WhatsApp group where I announce all the classes every day, just like I do up here, right? You have access to students asking questions, so usually you guys ask questions and somebody in the group helps out. You have the book, you have the Quizlet. Make sure you're taking access use of the Quizlet because it's for word association. It's more for that than anything else. It's not for you to test yourself, but to review certain terms. Like I was doing that right now with Poliana, the review of certain terms that might be confusing, especially in a chapter like this one. Certain terms are confusing, and if you don't go back to it, it'll become more and more difficult. So vocabulary, right? This one, I was asked not too long ago, what was the password for this? Right, Mohammed? And my answer was, once you complete 90% of the course, then you test yourself. Not now. See, I don't forget things. Not now. Make sure you guys only do that once you complete 90%. The other thing that's important, guys, is this. Replay of every chapter. So you can watch it on YouTube if you want. Go to the YouTube channel. Or you can watch it right here. You have the chapter pages specific to the chapter. And you have the review quizzes for each chapter. The same you can find at the end of the book, but the review quizzes are right here with the answers attached to it. So not like you have to go through a bunch of pages to figure it out. All right? But definitely, guys, take advantage of the student portal. I'm constantly trying to make it better and better for you guys. So you guys are way ahead than people were a year ago. A lot of things changed. But take advantage. It's free. It's included. So might as well. Okay. Let's see what we got here. Dre says only flashcards for Quizlet. Yes, don't use it for anything else because I did not set it up for testing under Quizlet at all. Eduardo, I don't see that option in my portal, only the link to go into Zoom class. Okay. Shoot me a message, Eduardo. Shoot me a message on WhatsApp so I can check your membership, okay? Might be something that's missing there, but I'll check it out. All right, YouTubers, if there's anybody watching, let me know you're there. If you have any questions, type them in the YouTube chat and I'll address them live, okay? So we're going into part 2 of appraisals. Part 2. Now, I saved the best for last, obviously, right? And it's the income capitalization approach. So we're going to have some math going on, and I need your attention, okay? So if you guys are laying down, try to sit up. If you guys are sitting, try to stand. Whatever you need to do, because you're going to need all the focus you can get, all right? So what is the income capitalization approach? What do we use this for? So the income capitalization approach is obviously used for income properties, right? So if the property generates income, rental income, like a multifamily, right? If it generates rental income, then the income approach will be one of the best ways to figure out its value. Now, sometimes we can use sales comparison approach as well, because a multifamily up to 4 family is very common. So we can use the comps, CMA, and we can use the income approach to determine the value of the property. But when we go to 5 units or more, they're not as common as 1 through 4, right? When we go to commercial, they're not as common. All of them have their own unique characteristics, right? So we need to determine, based on the income that we have and the expenses that we have, we need to determine what value the property has, right? So the approach is based on the principle of anticipation, right? That means the expected future income stream of a property underlies what an investor will pay for the property. This is not your average sale, right? Because when you go above 1 family, go for 2 or more, you are an investor, not just a homeowner, right? Because you have rental. So we're looking at how much is it going to bring. And this is key. You know why this is key to learn this stuff, guys? Because I see a lot of people buying $700,000 homes that only bring like $3,000 or $4,000 worth of income. That means if you're renting one of those units and the other unit decides not to pay, you're screwed. Literally. That's it. You just lost your house. Blink of an eye. Or if you lose your job. Or if you get sick. Here in the United States, I went for a surgery $250,000 later. Right? I saw those bills. I'm like, wow. Thank God I have insurance. Right? Just a surgeon, he was there for 1 hour, he billed $137,000. I'm in the wrong business, right? Anyway, so the point is, you get sick in this country, unfortunately, right? I'm not talking bad about the country. I'm just talking about the health system. If you're sick, or the labor system, you could get kicked out of a job without any excuse. I don't have to say, oh, because of this, right, I'm firing you. No, it's simply you show up and I'll be like, hey, thank you for showing up. You can leave. Happened to me 16 years ago. The reason why I'm in the real estate, right, is because I got kicked out of a company that I saved millions for, right? Worked hard to grow within the company, and then in the token of appreciation, they said, you can go home. Thank you very much for your service. Go home. Don't come back. Okay. Now, I understand they're going through hard times, and a couple of months later, they laid off 94 people. I think it was 94, something like that. Almost 100 people. But that doesn't help me that other people went too, right? It's not like, haha, you lost it too. No. So, the investing part of it. That's why usually I try to steer people off of a single family until they have something established. Because labor is not guaranteed. Our health in this country is definitely not guaranteed, right? So I try to steer people away from single families. Always go for a multi, and you can have your single family later once you have some type of ground, right? You have some type of foundation where you're getting that income, and if you lose your job, hey, you lost your job, you have something to fall back on, right? Now, again, why is this important? if you don't do your numbers right, and that's what we're going to go over more or less, if you don't do your numbers right, it's not an investment course, okay? But if you don't do your numbers right, you're setting yourself up for failure. And guys, a lot of realtors don't care about you. A lot of salespeople don't care about you, right? As a buyer, they'll actually sell you something just for the sake of selling because they need the money, versus looking at you, the individual, and can you afford it? Okay? I always ask the question, if you lose your job today, who's going to pay for the mortgage? Simple question to ask before anything else. If you lose your job today, who's going to pay the mortgage? Oh, my spouse makes enough money. Okay, great. So you settled. Hopefully, neither one of you both of you are not going to lose at the same time, right? So single family might be great for you. You have enough reserves. Spouse can pay for it. Husband or the husband or wife or whatever can pay for it. We're good to go. But I have to have that assessment versus just, you want a $500,000 house? Let's go look for it. Because banks will approve you for whatever. And this was proven back up until 2008. It was proven. They'll give you money. Like, take it. Right? They'll say they measure your approval up to a certain amount. Yeah, if they need money, they don't measure anything. They just say approved. And then you're the one stuck with a property that you cannot afford. Just saying. Gilbert wrote, I've been trying to tell my cousin this and they just don't get it. Combined income is $110,000. They're looking for $500,000 one family. The combined income is $110,000. Yeah. Yeah. Guys, if and they live in New Jersey? Sorry. Oh yeah. Get a multifamily for the same price. Multifamily. Build some income. And then in New Jersey, I think that's in the country in the South America. Bogota, right? I know I know where it is. I used to work close by. I was in Saddlebrook. And I used to work in what's right next to Bogota? Or Bogota, because we're in America. Bogota. Damn, I forgot the name. Anyway, but I used to work close by. Ridgefield, no. Anyway, no, it's okay, but it's right there. So people need to understand money. Okay. Now, it is also based on the principle of substitution. Jose says that's why you see them later renting rooms. Absolutely. Try to make as much money as they can out of the property. Toroa. That's what it was. Toroa. Anyway, so it is also based on the principle of substitution. So an investor will pay no more for a subject property with a certain income stream than the investor would pay for another property with a similar income stream, right? We talked about it. When I gave the comparison of the 3 mice for the computer, right? If you have something similar, like they bring roughly around the same type of income, why would you pay more, right? So we're going to look at income the same way. So the strength of the income approach is that it's used by investors themselves to determine how much they should pay for property. Thus, in the right circumstances, it provides a good basis for estimating market value. The income capitalization approach is limited in 2 ways. First, it is difficult to determine the appropriate capitalization rate. I'll explain capitalization rate in a second. This is often a matter of judgment and experience, just like with everything else, on the part of the appraiser or the realtor. Secondly, the income approach relies on market information about income and expenses, which can make it even more difficult to find information. So, for instance, if a property sold recently, and the listing does not include a commercial property, the listing does not include the income and expenses, right? Then how would you know? You got it? You have to have a connection with the property manager, for instance, or you have to have a connection with the previous owner, or just show up bluntly and ask, hey, what's the income and expenses on this property? Good luck with that one, right? So it's very difficult to get that information. That's one of the drawbacks of the income capitalization approach. But if you have all the info, very easy to work with. Now, the income capitalization method consists of estimating the annual net operating income from the subject property, then applying a capitalization rate to the income. This produces the principal amounts that the investor would pay for the property. These are the steps in the income approach. The first thing we do is estimate the potential gross income. We call it PGI. Estimated potential gross income. This means we assume that it's 100% rented. Okay? So this is assuming 100% occupancy or rental or income, because you might bring other ways of income like concessions, for instance. Okay? Step number 2, after we calculate, and we're going to go over this in detail, after we calculated the potential vacancy rate and the non-payment rate, because there's people that don't pay their rent, right? There's people that leave and then you have to replace them. It might take a month, might take 2 months, might take 3 months, right? So we need to be ready for, hey, 5% of the year is going to be vacant. 10% of the year is going to be vacant. If you're a hotel, up to 40% of the year, it's going to be vacant. Because hotels are never 100% occupied. Very rare for that to happen. But they already calculate those things, right? So then we reach what's called the effective gross income, or EGI. Meaning, this is what I can expect to make out of the property. Now, potential, 100%. Think about it. If you guys go to work, right, and you don't miss one day, you know pretty much how much you're going to make, right? For the whole year. If I don't miss one day, I'm going to make $100,000 for the year. If I miss one day, I don't get paid for that one day. If I miss 2 days, I don't get paid for those 2 days, and so on. Right? That's the vacancy. So we can predict more or less. Some people never missed work in their whole lifetime, right? But you got to be realistic about who you are. And some people find every excuse to miss work. But let's be realistic. I'm going to miss 10 days out of the year, as an example, right? So I know I'm not going to make 100,000. I'm going to make 90, as an example. So that's the effective gross income. That's what I can count with. If I happen to make 100,000, great. But if I only make 90, I'm still good. Are you guys understanding this? EGI is the effective gross income, what we can really expect. We can expect, okay, to receive. Jose on YouTube just wrote, February 14, hotels are full. Not this year. Anyway. Now, that's what we can expect from income, right? Now, nowadays you work from home. For instance, some people still go to work. If you go, let's consider that normal times, and you go to work. Everybody goes to work. If you go to work, do they pay you for the gas, the tolls, the maintenance of your car? No. So is 90,000 what you're going to make? No, you have to deduct your expenses, right? So when you deduct your expenses, we're going to reach what we call NOI, which is the net operating income. So we now know how much we can expect of the property, minus the expenses that we know about, not the, hey, what if this happened, what if that happened, right? It's the taxes, the insurance, the maintenance. That's guaranteed every single time, right? The utilities, guaranteed every single time. You're going to have the electrical bill, you're going to have the water bill, guaranteed. Those are called operating expenses. So I make 90,000, but then I got 40,000 worth of operating expenses. How much is my net operating income at the end of the year? Right? So we're at 50. From 100,000, we're at 50. Now the 50,000 It's the coming to my pocket money if you don't have a mortgage. So we still didn't get to a mortgage. But this is where we stop when we determine the value of a property, because not everybody is going to pay a mortgage, but everybody's going to pay taxes. Not everybody's going to have a 5% mortgage, but everybody's going to have the same amount of taxes, utilities, and so on. Are you guys understanding this so far? We're good? All right. So we're at $50,000 income, and this is the number we need. This is the key number. We need to be able to reach the NOI. This is the key number. NOI. Okay? We're going to go over the numbers in a second. Once we reach the NOI, we're going to figure out the capitalization rate or cap rate. Now, the capitalization rate is what we expect to receive in the area as a return on our investment. Okay? So it's the rate of return. Good so far? Once we figure out the comparables of buildings around that they are similar in style, similar like they're residential income properties. Mine could be 20 units while yours could be 100 units, but they're similar because it's residential. They have similar amenities. So I can use yours, even though it has more units, I can use yours as a comparison. You got it? Once we identify the expenses and everything, let's say the cap rate is 9% on yours, and I'm going to look at another one. So Poliana's property is 70 units, and the expenses, whatever, will not cap rate is similar to 9, so close to 9, right? And I find another one close by that has 10 units as an example. If the cap rate is very similar on this similar type of properties, then I can assume that my property's cap rate is 9%. Okay? It's the average. It's just like we did the sales comparison before. It's going to be the average of the cap rates around. Once I have the 9%, what am I going to do? I'll apply it to the $50,000 and I figure out the value. Okay? We're going to run numbers in a second. This is just to give you an idea. So, potential gross rental income. What did I say this was? It's the scheduled rent or the expectation of being 100%. Right? 100% income or occupancy, right? Because you might have other income like concessions. This is PGI or potential gross income. Just like your paycheck, you see the gross and you're like, oh my God, I wish I got that versus what comes into my pocket, right? Deductions, right? Which one do you prefer? The gross amount. There's deductions, there's expenses, there's this, there's that. Okay? That's why when you go to apply for a job that offers you $5 more, as an example, where is it? For me to get to it, does it take longer? Do I have to pay tolls? I have to consider all these things because $5 more could actually cost me more than what I'm going to make. So is it worth moving? Right? Or is this an investment now so I can have another position within the same company paying way better? Everything in life is an investment. You wake up, you invest. You just don't realize it. Everything is an investment. Most people make really bad investments every day. Bad use of your time, for instance, right? So there's people that spend 4 to 10 hours going through TikTok while at work. And then when they get home, they go to Netflix, right? Forget the kids. Invest. Andrea M. wrote workout. Workout is an investment in your health. Yeah, absolutely. Everything is an investment. Because people, like I said, like to waste time. So that's 100%. Now, for you to reach the effective gross income, which is what we could expect, as I said before, it's the PGI minus vacancy. What is vacancy? Property being empty, whether it's 1 unit or several units, but it's being empty. And their rent collection losses or credit losses, non-payment of rent. Okay? Every property manager or every owner has an idea what they can expect in their property. Like I said, could be a 5% loss, Could be a 25% loss, and some people are okay with it, right? McDonald's, as an example, at points they have a 45% loss just by knowing that Burger King is going to open across the street. But because they're still profitable, even with that loss, they invest. That's what hotels do. They know they're going to have a huge vacancy in a lot of seasons. But it's still profitable for them to open most of the times. You guys understand? So some places have more vacancy, some places have less vacancy. Some places are more prone for rent collection losses where people don't pay than others. Unfortunately, for the past year, rent collection losses have been crazy. Vacancy, none. Right? Everything is full. There's not one empty apartment, but a lot of people not paying. And it's a combination of things. So it's not like, oh, let's call them names because they're not paying. Some people, yeah, taking advantage, just like with everything. Other people, they really can't afford it. They lost their job, they lost their business, whatever it might be. And then there's landlords that are taking advantage of it. Landlords are collecting rents and then not paying the mortgages. So it goes both ways. There's always somebody trying to take advantage. Right? So that's the effective gross income. That's what we can expect to come in. Next page, we have NOI. Okay? NOI. This, like I said, is the number we need. And all these numbers, by the way, are annual. Okay? So this is all annual. NOI is what you need. How do we get to the NOI? I mentioned earlier. It was by removing, or deducting, I'm sorry, the total operating expenses. Jose says, and I'm getting cash rent payment too. He's collecting cash and not paying his mortgage. That's not what he said. But there are people doing that. All right, so EGI, effective gross. What we can expect minus expenses reaches NOI, the number that we need. Now, guys, operating expenses include fixed expenses and variable expenses. Fixed expenses are those incurred whether property is occupied or vacant. For example, taxes and insurance. Okay? Variable expenses are those that relate to the operation of the building, like utilities, janitorial, service management, and repairs. Jose, I know it was not you. I was just joking. I'm sorry. I'm like that. Sorry. I try to catch myself, but it's tough. Gilbert says, please keep on doing that so I'll get your homes cheaper. That's right. Some win, some lose. It's just the way it is. All right. Look what I have here in green. Operating expenses include everything. Remember I said mortgage was not included? Okay? Gotta remember this. Mortgages or any financing against the building is not included. No debt service. Why? Because I might buy the property cash. You might buy the property with a mortgage, right? You might buy a property with a mortgage at 10% while they might buy a property with a mortgage at 5%. That's a huge variable here. But management, utilities, taxes, insurance are equal for all of us. Okay? So very important to remember that. Okay? Very important to remember that. Debt service is not included when we're calculating in the income approach. Okay? Not included. If these numbers make sense, then the $50,000 that comes to my pocket, remember I said before in that example? If $50,000 makes sense, now let me look, if I were to pay this with a mortgage, how much would that cost? Okay, is it worth it? Maybe, maybe not. So we'll get to that. Select the capitalization rate. Capitalization rate is rate of return. already said that. And we'll talk about that better in a second. And we're going to apply the capitalization rate. So how do we apply? Here comes math. Ready? Formulas? All right. NOI. Let me write this again. Annual NOI divided by cap rate equals value. So income divided by rate equals value. This is called the IRV formula. Okay. Here's the good news. When we do the math chapter, I'm going to give you guys a cheat sheet and a simple tool for you guys to use where you will not have to remember formulas. Okay, so I'll save you from that. Okay, and no, it's not the calculator. It's not Google either, because you cannot use Google during the exam. It's a simple, very simple tool. All right, let's go to numbers. Ready? No? Ray's like, no, please. I got nightmares already. I already saw too many zeros. All right. All right, since we got 5 people watching on YouTube, and then I got you guys here watching as well, on my YouTube channel, New Direction School YouTube channel, I also have, if you guys go to the channel and search Income Approach, I have a video in more detail explaining 2 or 3 different questions that might pop up in the exam, and full in-depth explanation of the income approach. Okay, I think it's a 30-minute video just on this, but with examples like this one. There's an example. Estimate the potential gross income. So we're going to estimate if we were to receive the full amount of rental, how much would come in? $192,000, right? That's the rental. But then there's other income in this example. Like what? Sales concessions, like a vending machine, for instance, right? Or a laundromat, a coin-operated laundromat, right? The laundry machine. So that brings money. And let's say it brings another $2,000 for the year. Not much, but it helps, right? That means if everything goes well, this property is going to bring $194,000, right? If everything goes well, $194,000. Is that what comes to your pocket? No, right? Because we need to prepare for vacancy and collection losses. So it's that amount less vacancy and collection losses. In this example, they thought that $9,600 is more or less the amount we can expect to lose every single year. Okay? Based on my experience, I know I'm going to lose roughly $9,600. So what is my EGI, or what I can really expect from the property? $184,400. Okay? Any questions here? Mr. Cholvi. Minus a bonus to your realtor. That's right. That's right. Never forget, always give a bonus to your realtor. Gilbert, special you, since you're in the rush, you don't want to wait for your license, make sure you always offer a bonus to your realtor. I volunteer always as your realtor. Okay. All right. AGI is adjusted gross income, but that's for your taxes. Right? Where did you get AGI from? I said EGI. The effective, what we can expect to come in. Good. So AGI is when they're asking you when you do your taxes next year. Hey, what's the previous year's AGI, adjusted gross income? Okay. EGI, effective gross income. All right. Now, that's not what comes to our pockets still, right? It's getting closer. But we have operating expenses. Things don't run for free, unfortunately, right? So we have real estate taxes, insurance, utilities, repairs, maintenance, management, reserves, and legal and accounting. We have to pay the CPA that does the AGI, right? Sorry, I have to mess with you now. We have to pay for attorneys and we have to pay for accounting. How much do I have in expenses in this property? $84,000 a year, right? So I made $184,000. That was my EGI, effective gross income, right? Minus $84,000 worth of expenses. What is my NOI, or net operating income? $100,000. So how much really comes to my pocket if I have no mortgage? $100,000 every year, right? From the property. We still didn't do taxes, because we got to pay taxes at the end of the year, right? But this is how much I make from this property. $100,000 every year. All right? Oh, Gilbert, you can show this to your cousin. Combined, right? They make 110, you said? Right. One property could bring their income, right? Just saying. Now the capitalization rate, which we found out by doing comparables, I'm going to go over that again in a little bit. We found out by comparables. In this area, the cap rate is 7%. What we can expect for a property in this area, the rate of return, right? ROR, right? Rate of return is 7%. So what we're going to do is the IRV formula. Income, 100,000. Right, so the NOI, right, divided by cap rate. Okay? And it's not cap like today's cap, no, or bet or things like that. No, it's capitalization, income, money. Okay, cap rate is 0.07 or same thing as 7%. So $100,000 divided by 7%. Is 1.4 million. How much is this property worth? 1.4 million. What happened? Okay. Question, Gilbert. How much money do they have to put as a down payment on that $500,000 house? That's not going to bring them any income. Just saying, because depending on what it is, they might be able to invest at least half the price of this one. Maybe a 750, that brings them income. Just saying. You don't have to answer, this is a joke. So this is value. Would you look at that? 110,000 is what they have? Cash? That's what I was asking. How much they have as a down payment? Okay, because if they have $110,000 cash, I could actually help them get into a house that will bring them this $100,000 a year. They got like 40,000. Okay, they can still get into a nice income property. Just saying. 3 or 4 family. All right. Would you buy this property? Is there anybody that would buy this property? 1.4 million, but brings you $100,000 a year? No. It only takes 14 years for you to make all your money back. After that, it's pure profit. Right? Ron says, if I was rich. Really? You and Josh get together, come up with 200,000 and boom. Ready to go. Jose says, yeah. Sebastian Bez says, bad investments. Josh says, wait on it. No, you don't have to wait 14 years for the money. You'll get the money every year. It's just after 14 years, 15 years, if you do it right, you won't have a mortgage. Gilbert, if I was rich, I'll buy the whole block. Then you would have no competition. It would make no sense. Not buy the whole block, but buy several properties in the city. I don't have a whole block. I'll buy as many properties as I could. I wish I had more money to buy more properties, but I don't want the whole block because then, again, no competition. And the only way to make money is if somebody's competing with you. Isn't that what comparables are? Somebody puts an offer on something that's higher and higher and higher. And then if it's accepted, that's it. Most houses, you have to wait more than 14 years. Depends on how you do it. I can show you ways to get your houses paid off in less than 10 years. Depends on how you do it. Andrea M. Competition is market. Yep. That's it. All right, next. Another one to remember. Gross rent and gross income multiplier. Okay. So, Jose, I saw you wrote that before. This is the GRM or GIM. Gross rent multiplier or gross income multiplier. Let's see the faces, present and online. And I'm sure somebody's on YouTube like, oh my God. All right, it's okay. It's okay. That's why you have the replay. That's why every class is recorded on YouTube and in the student portal. So you can always go back to it or ask questions. But when do we use these? These are simplified income-based methods and used primarily for properties that produce or might produce income but are not primarily income properties. So usually single family homes and duplexes. Now usually a single family is not considered an investment property, but could you use it as a rental? Yeah. The problem is if you're the only one using it as a rental, how are you going to compare it? There might not be sales in the area, right? And duplex is the same thing. Usually these are not rentals. Okay. So the methods consist of applying a multiplier, right, to the estimated gross income or gross rent of the subject. The multiplier is derived from market data on sale prices and gross income or gross rent. So the advantage of this one compared to the capitalization rate, right? Go back to the IRV formula. The advantage of this formula is that it's not as complex. We don't need to figure out the net value. We can go based on the gross value. Okay? So we don't need to figure out how much they have in expenses, how much do they actually bring home. And it wouldn't make sense. It's a single family. Okay? It's not like you're milking a lot of money out of it. It's impossible. Almost impossible, at least. Right? O'Neill just wrote, most definitely one to remember. Yep. So here are the steps in the gross rent multiplier approach. What you guys need to remember is this. It's a multiplier. That's one of the things to remember. If it's a multiplier, guys, what do we have to do? Multiply, right? That's it. That's one thing to remember. If it's a multiplier, you have to multiply. So there's two steps in the gross rent multiplier. The first is the gross rent multiplier by examining, select the gross rent multiplier by examining the sales price and monthly rents of comparable properties which have sold recently. The appraiser's judgment and market knowledge are critical in determining an appropriate gross rent multiplier for the subject. The gross rent multiplier for a property is price divided by monthly rent equals GRM. Guys, it's just like the cap rate. Once we identify this, we multiply by the numbers in our property. Okay, so we're going to figure this out from the numbers in other people's properties. Now we're going to estimate, that's why it's multiplier, the value of our property by using the selected multiplier by the subject's monthly income. GRM times our property's income equals value. All right. By the way, these numbers are off. Unfortunately, I'm not the publisher. But the concept is the same. Numbers are off. Concept is the same. You guys remember when we saw this in comparables? Comparable A, B, C, and D. It's the same thing for all processes except for the cost approach. So in the IRV, for us to figure out the cap rate, we need to look at 4 or 5 comparables. Okay. Here, the same thing. And sales comparison approach, we went over that as well. Now, comparable property A. Sales price, $500,000. Sales price, $500,000. Monthly rent, $1,660. That's how much he brings in gross. This is gross monthly rent. The GRM is $151. So again, I said these numbers are off, but the concept is, right, we saw here the formula above, price divided by monthly rent. So this divided by that equals 151. Okay. Same thing here. Same thing here, and these all these comparables. I know, Josh. Way off. So all 4 comparables are done. Now we're going to estimate the average. The average of these 4, right, equal 160 GRM. Okay, this is the GRM, the average GRM. Okay, so now we do the opposite. If we went this way, we started off with this row divided by this row to get to that number, right? Now we're going to go opposite. 160 times 2,000 equals 320. So what we need to remember is that for all formulas, they're based on comparables, right? This one is based on gross rent, which is very simple. Anybody can find these numbers in any property, right? It's very easy. So you're going to find a property of 300,000. You're going to look at the rentals is 1,800. Divide one by the other. You have the GRM for the area. Simple as that. You use that number, multiply by yours. We have a value. Okay. Questions here? No? Guys, questions? Simple, right? Very simple. Come on. All right. And the GIM is identical. The only difference about the GIM is we have rentals or other income that's not related to apartments. Okay. So we have other income. So let's say we have the laundry machines coin operated, vending machines, right? Parking spaces. These are not considered part of the regular rentals. So this is additional income. So we're going to consider, instead of just the $1,600 of rental income, we're going to consider $1,600 plus another $100 in garage, plus another $20 from the laundry machines. We're going to add all that. Concept is the same for the rest. Questions? Nope. Well, yeah, I know you have a lot of questions. Maybe tomorrow. Okay. Jonathan, you have questions? Because apparently you're asking questions over there. Any questions? Huh? Yeah. Every time. Anyway, so to finalize, guys, this is last page. To finalize, regulation of appraisal practice. I'm not going to go too much in detail because, so to answer Josh, as I was already going to explain that, Josh is asking, is it difficult to obtain your appraisal license? Would it be beneficial in this field? So you have to understand one thing. Every license that you guys get is beneficial. The question is, can you focus on it? Can you take advantage of it? I have a lot of licenses that I don't use, but I don't use it as a professional. I use it as an instructor, for instance, right? Others I have as an instructor in my back pocket if I need for later, right? But I use it as a professional. Like I have the insurance license, life, health, property, casualty, got them all, right? But I don't need it for certain things. I need it for others. So it always boils down to, can you have your mortgage license as well? Can you have your insurance license? Can you have your appraisal license, your real estate license? You can have whatever you want. What are you going to use it for? Just like all investments, it's only worth if you put it to use. Now, you can make $400,000, $500,000, $600,000 per appraisal, and you can make 2 to 3 appraisals a day if you get a contract with a busy mortgage company, right? So will it be worth it? Yes. Let me just show you something real quick. For you to qualify for these, right, you have to learn all this stuff right here, right? All this stuff right here. Not much. You have to be part of these associations. Okay, it's not much. And it doesn't have here, but I can tell you right now, you're going to start as an appraiser, you're going to start as an apprentice. Okay? And that will be for at least a year as you're taking more courses. Then that takes you to another level, which is being licensed. So you go from making like $100 an appraisal, as an example, to then being licensed and be able to charge $300, $400 maybe. And then if you really want to make money, it takes 2 to 3 years and about 300 or 400 hours worth of courses, and you got to have a bachelor's degree at least, or associates, or whatever it was. I forgot it was. But it's, compared to this profession, it's too much work compared to this profession. Because guys, whatever you paid for the class, now you just need to activate your license. Another, let's say another $500, $600, and boom, you're in business. You're not an apprentice. I mean, you're learning, but you're getting paid for every deal you come in. Like well paid. So, and it's not me trying to say this is better than anything else. No, I'm talking about the investment itself, money and time. Right now, it's way faster and easier to make money. Does that make sense? No. I mean, you can come up with a value, but you cannot appraise your own properties for mortgage purposes, because then you're going to say your $200,000 property is worth $1 million, right? Okay. So no, conflict of interest. Just like I cannot insure myself, for instance. Just like you shouldn't do your own mortgage, for instance. All right, taking advantage. Are you screaming, Stephanie? It looked like you're singing opera for a second or something. Yeah. Gilbert says, I know 2 girls that took your class not too long ago and they're doing okay. All right. Do you know their names? Do they refer you? Okay, cool. Ron says, only okay? Come on, man. Only okay? Yeah, they opened their own real estate company. Trying to remember who it is. Oh, so cool. O'Neill just said, Bruno, I want to thank you for your class. I passed my license exam today. Congratulations, O'Neill. Very happy. Zoomers are clapping for you right now, right? As they expect to be the next one to pass. So very good. Good luck with your real estate business. If you need anything, you can always reach out to me. Not sure if you have my number already, but it's 908-418-8325. So always reach out. And because you're on YouTube, you're not in the Zoom class, I can tell you, if you got nowhere to go and you want to come interview us, give us a chance, come on over. Okay? All right, Gilbert says, I meant wealth. There you go. All right, guys, so this is chapter 16. We are done. If you don't have any questions, guys, I'm going to give you a break after all that math and formulas, right? And we will resume at 5:30 tomorrow for chapter 17. By the way, chapter 17 is broken down into 4 parts. It's only one chapter, but broken down into 4 parts. So it's going to be Tuesday and Wednesday for chapter 17. So yes, a lot of info. We're going to talk about real estate finance, mortgages, variable mortgages, fixed rate mortgages, all that good stuff. All right? So be ready for it. All right, guys. Have an amazing evening, an amazing day tomorrow. I'll see you at 5:30. Thank you.